Leverage is a bad word on most financial programs, and that's why the mainstream media, for the most part, ignores leveraged ETFs. We, on the other hand, are the Robert Frost among our peers because we take the road less traveled. And that's why we gladly talk about leverage ETFs and leverage products on ETF Battles, because not only do we enjoy it, but we also have a public duty to openly discuss the pros and cons of these products and let you decide, let you vote with your money. And that's what we're going to do on today's program, because today's battles between the ProShares UltraPro S&P 500 ETF, ticker symbol UPRO, versus the ProShares UltraPro QQQ ETF, that's ticker symbol TQQQ. Both funds use 300% daily leverage. UPRO, of course, linking to the S&P 500. TQQQ is targeted to the Nasdaq-100. Before I introduce our judges, be sure to watch our new weekly original series, the Portfolio Report Card, where I analyze and grade your investments, your IRA, 401k plan, and tell you if your investments are architecturally sound or not in key categories like risk, diversification, performance, organization, and so forth. So be sure to watch the program. So we're pleased to have with us Mike Akins at ETF Action and Dave Kreinces at ETF Portfolio Management, the best in the business. Judges, it's great to see you again.
Thanks, Ron.
Thanks, Ron. It's good to be here.
So we're going to start this battle by going through these four categories: cost, exposure, strategy, performance. We've got our mystery battle category that you guys can pick that factor or several factors that you think is crucial to today's battle. And we're going to give each one of you 30 seconds. And then at the end of the show, we're going to declare an overall battle winner. So why don't we start with Dave? Dave, we're going to begin with the first category, which is cost. Who wins the battle?
Well, this is an epic matchup. TQQQ, the American Dream ETF versus UPRO. Both of these ETFs are core holdings in the investable benchmark portfolios, and both have expense ratios near 1%. Now, given their performance, the 1% cost is immaterial, but TQQQ does have twice the tech exposure, and technology is the strongest market trend. So I'll give the win on cost to the Nasdaq-100 3 times TQQQ.
All right, thank you, Dave. Let's shift to Mike. How do you see it in terms of cost between these two leveraged ETFs?
Yeah, I think they both provide means to gain levered exposure to their underlying index very efficient manner. You pay up relative to you would a non-levered ETF, but today's point, you're getting very efficient access to a levered product. So I'll give the nod to the triple Qs simply because they've got higher volume, ultra liquids, so you can get in and out of the Qs at a very cheap cost. Whereas UPRO is very liquid as well, but just in total cost, I'll give it to the triple Qs.
Next up is exposure strategy. You're still up, Mike. Who wins the battle between these two ETFs?
Yeah, so right now, I mean, the Qs have benefited from two major factors. They're predominantly tech exposure or tech-like exposure, and they exclude financials. So you basically excluded one of the worst performing sectors and loaded up on one of the top performing sectors. If you believe that's going to continue, which I do believe that you're better off maintaining a higher exposure to a lot of the overweight sectors of the Qs, then that would be the direction you go. If you believe we're looking at a little more of a cyclical comeback, then I would look at the S&P 500, what's going to give you a little more of the traditional sectors. I'm going to give the nod to the Qs because I'm still bullish on tech, comm services long-term. And for that matter, I'll give it to the Qs. But like I said, it really comes down to your macro assumptions to which strategy you pick.
Thank you very much. Excellent insight. Now let's shift to you, Dave. How do you see it in terms of the battle on exposure strategy between these two ETFs?
So for strategy, I agree with Mike. These diversified U.S. equity ETFs have the same top 5 holdings, all big tech, but the Nasdaq-100 has roughly double the position size and double the tech exposure overall. And with machine learning expected to reach 10,000 IQ points in the decades ahead, we strongly favor the extra tech exposure long-term. So I give the win on strategy to the Nasdaq-100 3 times.
All right, let's shift to performance. So you're still up, Dave. Who wins the battle in terms of performance between these two leveraged ETF titans?
So early this year, we saw these ETFs fall by up to 80% over just 5 weeks in the coronavirus crash. However, their long-term upside is actually somewhat worth it. Leveraged ETFs don't always work as expected, but these 10-year returns show why Einstein called compounding the eighth wonder of the world. Through October 23rd, UPRO returned 12 times your money, and the TQs produced a sensational 53 times. So TQQQ actually delivered 4 times UPRO and over 21 times the unleveraged S&P. And this means a $10,000 investment in TQQQ would have grown to over $500,000 in just 10 years. So the win on performance goes to the American Dream ETF, TQQQ.
Those are some impressive numbers. Thank you, Dave. Let's shift to you, Mike. How do you see it in terms of performance between these two leveraged ETFs?
So I'll give the nod to the Qs just right off the top. Absolute performance has been fantastic. I think performance will probably outpace the S&P 500 looking out 5 to 10 years. But let's take it back a notch here. Let's just think about performance in triple levered ETFs, and let's think about something they all have in common, and that is they all launched after the financial crisis. We have yet to experience a protracted downturn since the inception of these strategies. And I think UPRO is a great example of understanding that these things don't necessarily look like they're supposed to. Over the last 3 years, if I look at UPRO versus the S&P 500, UPRO is barely outperforming, up 47%, despite the S&P 500 up 41%. I can actually find other strategies such as ITB and NAIL, both track the exact same index, but NAIL tracks the home builders at 3 times, where it's performed. ITB's up 100% over the last 5 years, but NAIL's only up 50%. And the reason for that is protracted downturns and understanding that triple levered ETFs are designed to be traded, not to be held. And that is a function of the strategy. Read the prospectus, they'll tell you as much. And I think that it's nice that we're looking at something besides just the triple Qs, because we can highlight that these things don't necessarily act exactly 3 times over full market cycles, over periods, especially if we have a protracted downturn. It's one thing to have, hey, the market pulls back like it did in March, we have a big downturn, and then everything's hunky-dory again, and we capture it all back up. What happens if we pull down 30%, but we get that 30% pull down to that 40% pull down over 2 years? What does that look like with these strategies? And understand that triple levered ETFs should come with skull and crossbone warning labels, and there's a reason for that. Does not make them bad vehicles. They're fantastic. If you know how to use them, it's a great way to get access to leverage. But just understand, when you're looking at these long-term track records, they all have one thing in common. They all launched after the financial crisis or at the very tail end of the financial crisis and didn't suffer through a long, protracted downturn in the equity markets.
Those are some solid points. We need to shift to the mystery battle category. This is where our judges can pick one factor or several factors that they feel are important to today's battle. And Mike, you're still up. So what is your mystery battle category and who wins it?
Yes, I'll send over a chart with this, but actually I jumped the gun a little bit. My mystery category is going to be ITB and NAIL. Use that example to understand that just because the market's up over 3 years does not mean these strategies will be. It's not a 3-time return vehicle. It's a daily 3-time reset. And depending on the behavior of the markets makes all the difference in the world. And when the markets are up and to the right in a nice, steady, low volatile environment, these things work wonders. But as we all know, the markets aren't always like that. And I think you just need to understand that when trading these triple levered, and I think the optimal word there is trading these triple levered vehicles.
So if I got that right, your mystery battle category is home builders.
That's exactly right.
Which makes total sense. I love it.
Dave brings the triple Qs into every conversation, so I feel like I could add a couple of things here and there.
So that's a split decision on your mystery battle category?
No, I mean, yes, it's a warning label. I can't even call it a decision. It's just understanding that triple levered vehicles don't always decision. How about that? Yeah. Incomplete.
Okay, very good. So let's shift to Dave for his mystery battle category. What is it and who wins it?
So Ron, before I get to my mystery category, let me just address some of the concerns here. when you look at these levered ETFs and you drill down into the sector, more volatile levered ETFs, you do have more, variation and deviance from the return you would expect. So it is an issue that levered ETFs don't work as expected, but the issue is magnified with the more granular sector exposure. When you're dealing with the NASDAQ-100, the S&P 500, long-term treasuries, you do still have that issue, and you can see it this year with UPRO being negative, with the S&P positive. But you do still have this 10-year data set justifying, the risk in these instruments. So I think it's a case-by-case basis. But even when you are using these larger asset class instruments, having overriding risk controls, having strong protection on the bond side, and having the right position size for your strategy are all very important. But just for my mystery category, as usual, it's position weighting. And our aggressive growth strategies can allocate up to 60% in either of these leveraged core equity ETFs when appropriate. So for position weighting, it could be a split decision, but I'll still give the position size win to the TQs because extra tech exposure is extremely important.
All right, very good. Thank you, Dave, for weighing in and for that background, that color. I should mention that our judges we've had multiple shot clock violations, and I, as the horrible referee that I am, have not enforced anything. I haven't thrown any penalty flags because I keep saying to myself, I'm going to give you guys just one more chance. And of course, I keep giving you one more chance, but nevertheless, it is what it is. Because we have to discuss these things, even if it takes longer than 30 seconds. So this is your opportunity, judges, to weigh in with your overall final battle winner between UPRO and TQQQ. Dave, you're still up, and then we'll end with Mike.
So to recap this epic battle, leveraged ETFs can be extremely risky at times. But both of these ETFs paid investors very well for the extra risk, thanks to strong performance in technology. And while leveraged ETFs don't work as expected, they can be extremely useful tools when used properly. So overall, we believe the data clearly indicates that leveraged ETFs are the future of investing, and I give the win in this battle to the NASDAQ-100 3 times, TQQQ.
Very good. Mike, you're up. Your final chance to weigh in on this particular battle. Who wins? Your overall.
I give the winner to the triple Qs because I think as a trading vehicle, there's more opportunities to trade the Qs than there is to trade the S&P 500 on a whole host of reasons, whether it's macro assumptions, fundamentals, or simply just putting a technical trading overlay on the strategies. That said, triple levered investing is not the future of core portfolio holdings, in my opinion. I do believe that we will go in market cycles where that will hold true. We know the risks associated with these strategies, and depending on the market environment we're in, makes all the difference in the world on these returns. And just keep in mind the last decade that we've had. That's our performance track record of these strategies. What type of market have we been in the last decade? We have been in a strong bull market with historically low volatility, unheard of low volatility, and that is simply not how markets normally behaving. So we'll see what it looks like 10 years from now if we get a more volatile market, protracted downturns, and see to what extent these things hold up for the long term.
Well, thank you, Mike and Dave, for weighing in. And according to my battle scorecard, today's winner is TQQQ. It beat its opponent in every single category. Really, the mystery battle category, Mike had a non-decision decision there, but everything else you guys agreed on. And actually, it was surprising to me that you agreed on it, even though you guys had different takes in terms of.
Come on, it's the American Dream ETF,
in terms
Ron.
of philosophy and where you guys are coming. And I think you both gave some solid arguments, each supporting your side of the story. And you guys did a great job in terms of judging this particular outcome. And of course, with some of those key takeaways, leverage, of course, has worked in the past, and we don't know in the future if it's going to work. It depends on the market cycle. So keep an eye out on that. We agree that technology is the place to be. Technology continues to evolve. It continues to lead global economies. and it doesn't seem like that's going to be a trend that changes anytime soon. Well, keep your ETF battles coming. Hit us up on Twitter at ETFguide. Be sure to hashtag ETF Battles. You can also hit our comment section below. Which ETF battles would you like to see? Again, a huge thanks to Dave and Mike for your insightful and timely analysis. We couldn't have done it without you. And be sure to watch our next episode of ETF Battles. And until next time, watch the battle before you invest.